The first market that I wanted to talk about is the euro currency. This is the same chart we've been looking at for the last several weeks. Go back and I just want to point out a few of the things. First of all, you see how it came down. It did not hit this median line, which was an indicator based on market behavior that the market is gaining strength and it will probably turn around. You can see that we didn't have a reversal day at the bottom. We had one right here followed by an inside day and the market came down. There was also another little projected date. At this point here, the market had traded up to it, hit this line, it hit the downward line, so that turned the market down. But the key was right here how we found support at this lower parallel line. We found it here, bounced up into this date, and it hit this resistance, came down, found support, and then look at this day right here, how the market touched it, came off and closed with a lot of distance in between, and then it broke up, came down, and then on this projected date, and I guess that's why I think the term reaction date fits better, because not every single time we get a reversal. Every reaction date could turn into a reversal date like you have here, and here, here, and here. But in this case, it's one of the rare times that the market actually accelerates and continues in the direction of the trend. Now this was an inside bar right before it, and the market came out, took out the high, and then it paused right here. This was the trail day, and the trail day closed higher in the open, which is another directional indicator. You had a couple little pauses. I think the pause was because that's what the 61%, that's right here, the sell window from here. But then it zoomed on through, big zoom day. It zoomed right through the median line, and it took out that high. So this previous high was kind of a target objective. I mean, we still have these dates projected out here that the trend should go up into. But typical market action now would be for the market to come back and test this line. So it could come back, test this line before heading on up. So if someone really wants to be in the euro currency, let me get up here. You know, you may want to put an order back down here if it dips down to about the 132.15 to 132.10, just to see if it dips down in here to get you a better feel for it to move up. Because now the probabilities are very high, then it's going to try to move up to these lines and up to into the 17th and the 24th. Now these dates, of course, are projected off the reaction here. I should say the action here gives us the reaction. That's what we're looking at here on the euro currencies. And before that, I want to drop back into show you something to help you. See, because you had this big move up. And the only way you can anticipate it is if, let's say, you were already long. You can see how the market is pulling away from the 20-bar moving average here, which is kind of a bullish indicator. We're turning up. All the indicators are up. But was there any sign to be able to jump in on this early and capture this? Well, if we jump over here to the 5-minute chart, I think most of you have been with us for a little while will recognize what we have here is we have a 4 to 7 trade. For you new people who are not familiar with the 4 to 7 trade, you'll see that I have your dotted lines here. And this is the market action overnight, usually from about midnight. I try to look at around about, well, shows you 150, 145 based on Mountain Standard Time. So that'd be about 2:45 Central Time, 3:45 in the morning Eastern Time. But I try to find a range from midnight on forward, and then I'll watch it really between 4 and 7. Sometimes you can go out to 8. You know, maybe we should call them 4 to 8 trades, but you can see. So I highlight the top of the range during that time period. You can see I just marked the high here, and then this was the low here, matched the low again right here. So there's your range. That's the windows here. And then the market dipped out of it. Kind of dipped before. Now, the trend had been coming up. So you look at it, it's kind of the trend is up. So we kind of expect it when it dips there, it's really going in the wrong direction, but it comes quickly back into it. So there's your false breakout. There's your what we call the failed swing pattern, which typically when you have that type of pattern, you look for a significant price move in the opposite direction. So there's a couple ways you can do. When you see that pattern, you can put a buy stop right here above this high, because what we're looking for is to break out. Or, as we always talk about, you have your second chance. In this case, see, the market moved up and it comes back. It moves through the moving average up, but it comes back and tests it. So you formed the swing pattern and you have this test. So you have what we call our double cross bullish pattern. And at that point, you can either buy it on a breakout or you can buy it right in here. It depends on the trader how you want to be aggressive, because this is a little inside. Well, that's not an inside bar, but it is a small range bar. It's a narrow range bar. So you can take off your bite here. You have a small stop. But as you can see right here, the market right about 130, 160, rallied all the way up to 133 before you put this big extended double top in here. Which, typical market behavior, if you get a big wide range up and another one down, it's a double top. Great sign that the market has exhausted itself. Now, interesting enough, you look at this chart pattern, the chart action. This is the price action coming into 630, and then right here. So this set up the bell. This set up the buy. A couple of things for you to buy. And then the market drifted higher. And then right around here, it was the president of the European banks, Draghi, made a statement that caused all the currencies to rally. So the price action, the market was all set up for it. I don't know, maybe it knew something was going to happen, but that's what accelerated the trend. So you would have already been in there. And then you see, of course, theirs was your initial reaction swing, kind of a TR pattern right here. There's your TR pattern, and then you have a little swing pattern right here too. So if you were late, you still had a buying opportunity here. So I wanted to bring you up to date on the Euro currency trade that we've been talking about. You can see right now it's July 12th. And so the market right here, here's the day it surged through, followed by an inside day. This was on the 7th. As you know, we were projecting the market to move up into our first reaction day was the June 17th. Euro currency did continue the upward trend after testing the median line right here. Moved up here. Now, it did go one more day, so we missed the high by 1 day. But it stalled out on the 17th. That was the end of the cycle. You can see we did pass through the first reaction line target right here, but did not take out the second reaction line target. So it came right in the price objective. So time and price did come together, ended the cycle, and very soon after that the market turned and had a dramatic downward trend following that. So hopefully that helps, gives you the information, gives you a little more insight on how the action reaction works.